Tonight, guys, we are going to cut the BS. I love it when customers call and they're very straightforward. Minh, what can I afford? How much can I qualify for? Tonight, guys, we're going to talk about the main reason why people qualify for a mortgage or not qualify for a mortgage, or how much they qualify for. Tonight, we're going to explain DTI, debt to income ratio. What's going on, guys? My name is Minh with What's a Mortgage. Welcome to our channel. The goal of our channel is to educate, empower, and to connect you with the right mortgage. If it's your first time tuning in, do me a huge favor. Let's join the WAM fam. Hit the subscribe button or notification button so you're notified every time we go live or post new content. Also, when you're part of the WAM fam, you get to talk to me. Guys, also, this is an interactive live stream. Do me a huge favor. Interact. Ask a lot of questions. If you have any uncertainty about home ownership, tonight is the night to ask. It doesn't matter if you're buying tomorrow. It doesn't matter if you're buying next week. It doesn't matter if you're buying a year from now or 5 years from now. If anything is holding you back from understanding how mortgages work, definitely ask questions. All right, guys, tonight we're going to talk about DTI, debt to income ratio. The number one question people ask me, right, besides down payment, monthly payment is, Minh, how much do I qualify for, right? And the worst thing to happen to a consumer is Saturday or Friday night, Saturday morning, they're looking at a list of all the houses the realtor has emailed them, right? The realtor emails them all these links so they can see houses. So, of course, they're clicking on these links, and they love the house that's typically above what they qualified for. And now Saturday morning or Friday night, they got to hunt down their lender to chase down an updated pre-approval or pre-approval letter. Tonight, guys, we're going to show you how to understand your debt to income ratio so you don't have to worry about chasing down a lender, chase down a realtor, but you have the confidence to know what you qualify for. All right, guys, let's get into debt to income ratio. Right, you'll hear this word all the time, debt to income ratio. What's your DTI? Your DTI is too high. You have tons of room on your DTI. First of all, what is your DTI? It's your debt to income ratio, okay? So we're gonna talk about what's your DTI, and your DTI is pretty much like a monitor, right? It's there to monitor how much you can qualify for, what can you really afford to pay, right? It tells you, let me go here. It tells you, right, the ratio of the debt to your income, right? It indicates how much debt you can handle. It indicates how much more debt you can handle. It also tells the lender how much more room you can afford on your mortgage payment, right? Also, guys, remember, with debt to income ratio, the higher the debt to income ratio, the higher the risk. The lower the debt to income ratio, the lower the risk. That plays a very big part when you're qualifying for a conventional mortgage. So when you're trying to qualify for a conventional mortgage with private mortgage insurance, if your DTI is under 45%, I know this sounds strange right now, but you'll understand as I explain it later on. If your debt to income ratio is under 45% before PMI, you get a discount on your monthly PMI, right? That's why it's really important for you to understand PMI. Because, of course, the higher the risk, sometimes banks might want reserves, right? Just to make sure that you can afford the payment. So a lot of things factors into the DTI. That's why I'm telling you guys, the DTI is the nitty gritty, right? Credit score, right, is great, but credit score also spits out debt. With that debt, you have to figure out your DTI, right? Income is great, but the income there is to be validated, and it determines your DTI. Down payment is great, but typically you're bringing in a bigger down payment to lower your DTI, right? Or you're paying off debt. And whatever debt you're paying off is there to lower your DTI. So guys, one of the main reasons either a loan will die or not die is because of the DTI, right? Everything is focused around this DTI, right? A lot of times what happens is consumer goes out, talks to a lender, runs their credit, brings in all their income documentation, and the lender eyeballs the income. Remember, when you're going to a loan officer, they're very optimistic, right? They're thinking they're commissioned. They're very pushy, right? They're riding until the wheels fall off. And a lot of times when they issue your approval, that's why I don't love these pre-approvals. I like underwritten approvals. The reason why I like underwritten approvals, because the underwriter has seen the income, the credit, and the asset. So the DTI is pretty fixed, right? The last thing you want is for the DTI to go up after you've been underwritten approved. And typically that won't happen unless your income starts declining while you're shopping for a home. Okay, so here's a scenario. Like I said, you go to and this happens to a lot of people. So if you've been approved already, make sure you keep your income up so your DTI stays the same or better, right? If you haven't qualified yet, you're gonna bring in all your paperwork. You're like, oh, Sally, I fell in love with the house, right? And then you go and you tell your husband, Buck, we gotta go get approved. You go get approved, right? And they get out your pre-approval letter and you go out, you find your home. And now it becomes real. And all of a sudden now, because you open title and escrow, the lender pulls a VOE, right? Now an underwriter finally looks at the income and they cut that DTI. And all of a sudden, shattered dreams, right? Broken hearts, right? It happens so often. So that's why I'm really about this DTI with you guys, right? Also, this is why you got to work with, so I feel you should work with, if it's not a big lender, but a lender that pulls your VOE up front and a lender that lets the underwriter look at your income and credit up front. Why is that important? Because that right there will determine your DTI. Also, guys, when you do get approved, tell your lender, hey, give me my max DTI. I'm not saying you should go to the max, but you should know your max limit, right? Also, what factors into it is your credit, your interest rate. If rates go up, that can bump up your DTI. Let's say, oh, you're excited, you qualify for a home, right? And you barely are skidding by there. And all of a sudden rates go up, that can jack up your DTI, right? So that's why I really want you guys to focus on your DTI. I really want you guys to talk to your lender. Hey, lender, I know I love the great rate and everything, but hey, have you pulled my VOE yet? Why not? I need my VOE pulled. I need your underwriter to review my VOE plus my paycheck and give me some absolute answer on my DTI. Once you know your DTI is set, the underwriter reviewed it and they cleared that, now when you are out there shopping, there's certainty, right? The biggest uncertainty is the DTI. Everything else, credit, you run it, it is what it is. Income, you get the VOE, it is what it is. But once that comes in, that changes your DTI. And you want that DTI to be as accurate as possible, okay? So let's get on. There's two types of DTI. Let's talk about the first part of DTI, your front end debt to income ratio, right? So when you talk to a lender, you want to ask them, hey, what's my front end DTI? Your front end DTI is your household debt, which is your principal and interest payment, your property tax, your hazard insurance, your PMI, your HOA, your Melrose, or your flood cert, right? Insurance, right? If you have in the flood zone. So definitely, guys, your front end DTI is your household debt, right? All lenders, depending on the program too, has a different DTI. Down payment system has a different DTI, right? If you go with a jumbo loan, has a different DTI. We'll go over that in a second, okay? So when you talk to your lender, what is my front end DTI, right? It's just your household debt. If you are currently renting and you're buying a house, do not include your rent in your debt to income ratio, especially the front end, right? That front end is gonna be your mortgage payment, your front end DTI, okay? So now that we know the front end DTI, the next one is the big one, the back end DTI, right? Your back end DTI. So understand, a lot of you guys are trying to figure out your DTI, and I get calls all the time, I get messages pretty habitually, Minh, did I do my DTI right? Minh, what should I include this in my DTI? Minh, should I include this in my DTI? This is what is including your DTI. If you want to add more to the DTI, you can go ahead and do so. But this is what's included in your back end DTI. It's called your complete DTI. It's your household debt, so it's the front end DTI. Plus, if you have any child support, any alimony, any IRS payments. If there is a monthly payment on child support, alimony, IRS, that is included in your DTI. And of course, your trade lines, the monthly payment on all your revolving debt, right? Your monthly payment on your installment debt. So any debt you personally guaranteed with your credit will be on your monthly DTI. It will be on your DTI, right? Derogatories, charge-offs will not be on your DTI. Collections, if the collection's over 2,000, you take the collection, times it by 5%, right? And then include that in your DTI. For example, right? If it's 3,000 and it's 5%, you include $300 a month in your DTI. All right. So remember that for your collections. If you have any back taxes, any back child support, as long as you've set up monthly payments, any judgments, you include that payment in your DTI. Okay. This is what's not included in your DTI. So when you're sitting there trying to map out your debt to income ratio, you want to make sure you don't include utility bills, cell phone bills, car insurance, health insurance, life insurance, any insurance you do not include in your DTI, right? If you have a medical collection, it's not included in your DTI. If you want to include those, that's up to you, okay? A lot of people are like, well, I do have these bills. Why shouldn't I include it? If that's what makes you feel comfortable, then include it. But some of you guys are trying to qualify for a certain dollar amount. Do not include it because the lender is not including it. Your gym pass is not included in your DTI. Your Disneyland pass, actually RIP, right? There's no more Disneyland passes, right? If there was one, those are not included in your debt to income ratio. What is included is your future mortgage payment, right? Your child support, alimony, IRS payments, right? And all your trade lines, revolving debt, installment debt. Even if it's a car lease, right? You got to include it in your DTI. All these things are included in your debt to income ratio. So when the lender approves you, they encounter all these things, and that's what they include in your debt to income ratio. Okay. Now that we know how much debt is included in your debt to income ratio, what's the next step? How to calculate your debt to income ratio, right? So now that we know what's included, what do we need to do? Calculate it, right? We need to include your monthly debt, right? That's going to be all your revolving debt, installment debt, right? Mortgage debt, child support, alimony, right? If you're paying any IRS payments, okay? Collections over 2,000, right? Student loans, okay? So all of that is included in your monthly DTI, right? So, and then your mortgage payment. So you want to tally up your complete monthly payments on all your liabilities that you personally guarantee with your credit, right? And then all the other little liabilities that we talked about. And then you want to include your mortgage payment, okay? The mortgage payment that you're comfortable with, okay? You add those numbers together and you divide by your gross income, your monthly gross income, not your yearly, but your monthly, okay? Once you divide that, that will give you a DTI. Here's an example. $1,100 in monthly debt plus $2,700 for mortgage payment. So I'm assuming the house is probably going to be $450 to $500, right? And the monthly gross income is $8,500. When you divide, the DTI is 45%. So I can tell you right now, without talking to a realtor, without talking to a lender, I know what I qualify for, right? And hopefully you know now what you qualify for, right? Do not wait or hesitate and, not do the numbers yourself. Run the numbers so you can run your life. Run the numbers so you don't run out of time, right? So calculate these numbers. If you do talk to a lender, and if what you want to know from your lender is, hey, what is the gross income that your underwriter has validated? Now you know, whatever they validate, take that number, times it by 45%. That's the max. If your guideline that you want to go for is 45%, that's what you want to stay under, right? If you want to go over 45, a lot of programs let you go to 50% DTI. If you're going with a government loan, it can go up to 55 to debt to income ratio. I wouldn't recommend that, but it can go up to 55%, okay? So now we know, right? What is your DTI, right? Debt to the ratio of your income, right? It is an indicator of how much debt you can handle, how much debt you can take on, how much you can afford for your mortgage payment, right? And like I said, the higher the DTI, the higher the risk. The lower the DTI, the lower the risk, okay? So we know what is DTI. Now we know what's included in your front end DTI, right? There's two DTI, your front end, right? Which is gonna be your complete mortgage payment. Do not include any rent, just your complete mortgage payment, right? And then the back end DTI. That back end DTI is gonna include your household debt, right? the front end DTI, it's to include your child support, alimony, IRS payments, right? And of course, your trade lines, revolving debt, installment debt, right? Mortgages, if you have other mortgages too, right? Derogatories, right? Collections, no charge-off, you don't count, right? And also, guys, remember, do not include your utilities, cell phone bill, car insurance, life insurance, health insurance, right? I said cell phone bill, right? Medical collections, do not include those, right? Do not include your gym passes or your Disneyland passes, right? So now we know those. Now we know what's in the front end. We know what's in the back end. Also, we know how to calculate your debt to income ratio, right, guys? Hopefully, this gives you enough information for you to determine what you can qualify for. And then second, we're going to put it on a calculator to make your life a little easier, okay? So now we know all that. The next step is, what DTI should you gauge your qualifications off of? Let's get into that, okay? So if you go with a conventional loan, your front end DTI, you want to keep it under 45%. Your back end DTI at 50% max, okay? Do not go over 50% on conventional because you're not going to get approved. Typically, if you're under 700, you might even have to stay under 50% DTI, maybe like in the mid 40s, right? But if you're above 700, 720, I can see a 50% DTI. Where you're going with conventional, I mean FHA, VA, USDA, 45% front end, 55% back end, right? Seems like the front end from FHA or conventional is the same, 45%. But of course, you go jumbo, it's a little bit different, right? So definitely, guys, understand that. Seems like all lenders want you to stay under 45%, right? I see a lot of people, right? If they don't have debt, doesn't mean they can go over 45%. They still got to keep at 45%. So take your gross income, times it by 45%. That's the max your mortgage payment can add up to. But if you have debt, you will not hit that 45%. You will not be able to hit that 45%, right? Because you have debt as well, okay? So remember, right? It's your front end and your back end. Your back end includes your front end plus all the other types of trade lines, right? All the other types of debt, right? Like your child support, alimony, right? Student loans, anything like that. That's including your debt, okay? So remember those things when you're trying to figure out your DTI, right? You want to stay between the 45 to 50, all right? Here's a little cheat sheet for you, for some of you who are trying to figure it out, right? I put 40 on there because some lenders, depending on if you're going with a jumbo product, right, they will have a 40% DTI. Some jumbo products is a 43% DTI, right? Or you qualify for a manual underwrite. A manual underwrite, the back end can't surpass 43%, right? So if your credit is under 580, some lenders will downgrade your FHA loan or VA loan to a manual underwrite. That's when you have to go with the 43% DTI, right? And then of course our 45% is our standard front end DTI, right? Some lenders that are giving smoking deals, they want that front end, back end to be at 45%, right? And of course, we have our standard 50% for conventional loans and 55% for FHA, VA, or USDA. There are talks on VA, you can go over 55% DTI, but I wouldn't recommend that. Why is that? Do you want to own a home and eat top ramen forever, right? Home ownership should be the American dream, not a nightmare. Don't buy a home where your DTI is too high, where it becomes a nightmare, right? You want to focus your energy on loving the house. And the best way to love the house is to love the payment. All right, guys? So that right there is debt to income ratio in a nutshell. Let's recap one last time, and we're going to go to our Techylender calculator, and let's put it into action, right? So what's your DTI? It's your debt to the ratio of your income, right? It's the indicator on how much debt you can take, how much debt you can afford, how much you can qualify for your mortgage payment. Also, the higher the DTI, the higher the risk, okay? The lower the DTI, the lower the risk. You can get this cheat sheet by downloading our Ultimate Mortgage Guide. It's on our website, whatsamortgage.com. You can download our Ultimate Mortgage Guide, and it has our DTI cheat sheet in there. All right, we're gonna send you a link, all right? Jolene, right? Also, let's talk about front end DTI. It's your complete household debt, okay? We're at front end DTI. Your complete household debt, okay? So it's your mortgage payment, tax, insurance, HOA, PMI, that's your front end DTI. And your back end DTI includes your front end DTI plus right? All the other little things, right? Your trade lines, right? Your revolving installment, right? Collections, right? Include those in your DTI. I also let you guys know what is not included in your DTI. And also we showed you how to calculate your debt to income ratio, right? It's your complete mortgage payment plus all your debts, right? Divided by your gross income, okay? And of course that will give you your DTI, but we're gonna make sure you know, right? Your Front End DTI, right? And then last but not least, what DTI are you looking at? Okay, we're looking at a 45% over 50 on conventional loans, and we're looking at a, let's go to this one right here. Ooh, 45 over 50 on a conventional loan, and on FHA, VA, USDA, 45 over 55 max, right? Of course, last but not least, our DTI cheat sheet here, guys. You don't have to write these numbers down, okay? They are in our ultimate mortgage guide, right? On the DTI section. Remember, there's 4 keys to unlock a mortgage, and we talked about it. Identity, which is really important, especially for those of you who are DACA. Conventional is, FHA is taking DACA now, right? DTI, identity, credit, income, DTI, right? Everything revolves around this DTI, okay? But we have to know identity first, credit first, income first, and then we can focus our energy on DTI. For everyone who asks a question, I will answer everybody's question as soon as we're done. But if you have questions regarding DTI or anything else, please ask the questions, and I will answer all your questions at the end after I do the Techylender calculator, okay? Let's go to our Techylender calculator. So I want you guys to go to techylender.com if you have a chance, right? Check out our calculator. If you go here, right, you can put in your credit score. Let's see here. Where's here? Right here, right? And then you can pick F, you can scroll down. Make sure you click the qualifier, right? When you click that qualifier, you can set your DTI here. 45, 50. Once you set it, it will let you know if you go over your debt to income ratio, okay? Let's say you put your monthly gross income. Let's say you make seven grand a month, 84 grand a year, right? 84 grand, 7 grand a month. Hold on. 1, 2, 3. Let's say you have $800 a month in debt. Okay. So here you don't have to put in your mortgage payment or anything. It calculates it for you. Let's go up to FHA. Let's go 500,000. Right. Let's go with LA County. Let's make my life easy. Pick a rate. If you don't know where interest rates are at, right, it will tell you where rates are at, right? Conventional is 2.84, FHA 2.79. So let's go 2.75 right here, right? 2.75, 30-year fixed. Down payment's 3.5% down. It'll calculate everything for me. It will tell me my payment is $29.25, and it will tell me my DTI restructure back end ratio is too high. I'm 41 over 53. Remember, FHA can go to 55, but if you're like, you know what? I want to be a little frugal. I do not want to go that high. It'll tell you here, available liability. You have to pay off at least $225 a month in monthly debt if you still want that house. Or you scroll up, right? Let's say you eliminate 500 bucks. Let's eliminate 300 bucks a month, okay? Boom. Now you qualify, right? With this Techylender calculator, when you see the red of your back-end ratio and your available liability, it tells you how much debt you need to pay down to qualify. Let's say you don't want to pay down that debt, right? Let's put it back at 800. Right, so sometimes I recommend you guys pay down debt, and we'll talk about that on another day about how to lower your DTI, right? So you would have to drop the purchase price, right? 450, so you went from 500, 450, 1, 2, 3, right? 450 to make your DTI qualify. You have 66 bucks to spare, okay? So that right there, guys, helps you figure out your debt to income ratio. So some person who makes 87 grand a month, has about $800 a month in debt, their max debt to income ratio, right? If we put it at 50, they can afford a 450 home or eliminate maybe 300 bucks a month in debt, which is a little bit easier to qualify, right? Who wants to lower their purchase price from 500 to 450? Nobody, right? Everyone wants to keep it at 500 because you want the best bang for your buck on house. That's why sometimes it's better just to eliminate the debt. But the best way to tell is to run the numbers, guys. Run the numbers so you can make the best decision for you and your family. But now I have empowered you. I'm passing on my scratching stick to you, right? Use the force right here. And now you have the ability to run the numbers. You have the ability to see what you should do. Should you come in with, drop the purchase price? Should you pay off debt? Should you increase the down payment? Should you buy down the rate? Everything you do is to get the DTI to a qualifying level, right? Because if that you can't do that, you will not qualify to buy your home, okay? And then you can tell how much further can you go, right? That's why, guys, I emphasize so much on debt to income ratio. Enjoy the night. We want to end all our live stream with our attitude is gratitude. Without you, there would be no us. Again, thank you so much for watching our show. If you have any challenges or concerns regarding what's a mortgage, call me 714-332-2526.